Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And Happy New Year. Welcome to 2026. Look forward to spending the year with you, at least on this podcast, and sharing, hopefully lots of insightful information and commentary and so forth. So today I want to get into the third part of the four-part series that I've called Wealth First Principles. And of course, first principles sit under every successful wealth strategy. The idea is that, sometimes we sort of drift away from some of these first principles, influenced by, noise in the media, new products, market commentary, fear, greed, these sorts of emotions. And really, the first principles are the absolute foundation of making great financial decisions. So whether you're an experienced investor, hopefully it's a great reminder to sort of recalibrate. If you're new to investing, it's a chance to start with some clarity and avoid some of the common mistakes. So if you know anyone that's going to benefit from listening to the podcast, maybe in 2026 and beyond, this series might be an excellent place for them to start as a really good entree into what we sort of talk about. So just as a reminder, in the first episode of first part of the series I talked about, what genuinely creates wealth. And I shared the wealth equation in that, which is surplus times investment efficiency multiplied by time. In the second part, I spoke about property and, the 7-step process that you need to go through, or that is the most robust process to go through in order to invest in property in a way that's going to maximize long-term outcomes. And today I want to talk about share investing. And I know I've spoken a lot about it in the podcast generally, but I sort of want to bring it all together in terms of quite similar, like I did last week with property, to, what is the approach to share market investing that's going to be most successful. Like with most things I talk about, it starts with a simple evidence-based approach. And for most investors, a simple rules-based investment strategy using low-cost index funds or diversified ETFs will produce the better long-term result compared to selecting individual stocks to invest in, or being very active in terms of investing in certain sector-based ETFs, or in fact using actively managed funds. So that is professionals that are managing the portfolio. And the evidence is unequivocal. There's a huge body of evidence, including the SPIVA reports, SPIVA. If you just Google SPIVA report, it'll take you to that wealth of information. It shows the majority of active fund managers fail to beat the index. And underperformance isn't due to just poor skill, it's structural. You've got to charge high fees in order to run an active managed fund, because you've got to employ hopefully really smart people to work out which stocks to buy. It's going to have higher turnover, so you're going to be buying and selling more often. That's going to trigger additional costs and taxation consequences. There's some behavioral pressure. There's market efficiencies kind of working against you as well. In contrast, index funds or diversified ETFs just deliver broad market exposure, very low cost, allowing the investor to really capture the market return with minimal friction. And really, the market return is available to everyone, regardless of how much money you have, how much time you have, and how much expertise you have. And it's really important to understand the data behind performance as well. So if we look at US data, for instance, there was over 2,000 funds that just followed the S&P 500 index. And of those in 2022, 50% beat the market. So about 1,000 funds or so. By 23, only 5% of those winners in 22 were still beating the index, or at least in the top quartile of performance, which is probably broadly, not all of them going to beat the index, but a lot of them. And then by 24, so 3 years in a row, less than 2%. So it's like picking a needle in a haystack. You've either got to pick, which fund manager is going to beat the index this year and then switch. So sell out of that fund manager and pick the next best winner. Mission impossible. Or you've got to try and find that needle in a haystack, which is the one of the 2% of funds that are going to outperform 3 years in a row. And I think, that they do actually produce reporting around longer term performance than just 3 consecutive years. And the performance, as you can imagine, is even worse. So the argument then is, if professional fund managers can't pick stocks, What chance do you have in doing so as a layperson if it's not your job? So when investing in shares, it's important to understand where the returns are going to come from. And I spoke about this year, I introduced the concept of the equity risk premium, which is the premium that you should earn or is available to earn over and above the risk-free rate, which is typically the 10-year government bond rate, because that's the rate, that's an investment return that you can earn really with taking pretty much zero risk. So then if you're going to take some risk and invest in stocks, what are you going to earn? And that's the equity risk premium. And you want to make sure that you're well compensated for taking that risk. So for example, if the risk-free rate was 2%, and the equity risk premium is only 1%, so you could earn 3% in total, you're just not going to do it. Why would you take the risk? Whereas if you were convinced that shares were going to return 10%, then you're getting a strong equity risk premium. And so it's really about then understanding what those future returns look like and whether you're going to be well rewarded for, taking that long-term risk in terms of allocating some capital towards that market. And really, returns can be earned from multiple sources. So it can be from growth in earnings. So that is, a company, the value of a company is really the value of its future cash flows. So how much profit will it earn? Because obviously a company that doesn't earn any profit or cash flow, arguably, technically, its value is zero, because why would I invest in it if I'm not going to get my money back? So it's really about those future cash flows. It's about growth in those future cash flows. It's about franking credits as well. In Australia, there's a greater focus on dividends and franking credits and income, whereas overseas, the focus is on, can the business reinvest those cash flows? If it can't, then it'll return capital shareholder through buybacks and these sorts of things. So really, to maximize your return, what you want to do is invest in markets where valuations are attractive. So either they represent intrinsic value or in fact that they might be trading at a discount, and where the underlying earnings are sustainable and there's going to be some growth in those earnings as well. So, for example, a lot of people like to invest in emerging markets because, as their description suggests, those markets are emerging and there is a lot of growth in those markets, or typically more growth in those markets, because they're not yet developed economies. And that's where you can earn your return. Alternatively, if you invest in an index that is cheap, say 3 years ago, for example, the FTSE 100 in the UK was relatively cheap on a PE basis compared to other developed markets. And so you can earn your return there from a little bit of mean reversion in terms of the value of, or the valuation of those stocks that make up that index, returning back to their long-term mean. So as a share investor, you just have to understand that's where your returns are going to come from. And it's an important starting point because it'll help you, once you understand where those returns are going to be driven by, or what those returns are going to be driven by, helps you make better decisions in terms of how you invest. Now, I want to talk about some common mistakes. Over the last sort of almost 25 years, I've seen a lot of share portfolios, and there's some common mistakes that people make. The first one is overtrading. So, the challenge, Warren Buffett, or it could be Charlie Munger, I can't remember, said that you shouldn't unnecessarily interrupt the process of compounding returns. So buying and selling should be something you should avoid, because what you want to do is earn most of your return in capital growth, and you want that capital growth to compound, and you want to avoid having to pay tax, because obviously that eats away at that compounding. You will eventually when you sell the stock, of course, or ETF, but you want to avoid it for as long as possible. So over trading and being impatient will create a cost drag and will destroy returns. Attempting to time the market. So I guess that's trying to sort of get into the market at the right time and get out of the market at the right time. Quite often, behavioral finance tells us or shows us that, in fact, most lay person investors completely mess it up and buy high and sell low, which is obviously the best way to lose money. Chasing recent performance, and we're certainly seeing this over the last sort of 10 years, particularly in the US, but investing in what is popular rather than what is attractive from a fundamental perspective, that can be a really challenging thing. It works to some point, but if you're going to invest in what's popular, if you're going to invest based on momentum or sentiment, then you need to make sure that you're going to nail your exit strategy. So that is, you're going to sell at perfectly the right time in order to maximize those returns. And then just abandoning, I think, the investment and the investment strategy when some volatility hits. That's a common situation as well, particularly if there's not a lot of conviction to begin with. If the conviction is paper thin, then of course you're going to, at the first signs of volatility or risk, you're potentially going to abandon the strategy. The best solution to this is a disciplined, rules-based approach because it reduces the number of decisions required and it removes emotion from the process of investing. And consistency, not cleverness, is really the driver of long-term returns. And that's why I really like the idea of a evidence-based, rules-based approach because it makes executing the strategy a lot simpler and a lot easier to follow, I think. Now, when people think about indexing, they typically think about traditional market cap weighted indexes, which has been very popular with likes of Vanguard since the 70s, really. And a market cap weighted index, of course, invests in the index, the companies that make up an index, proportionately to their value relative to the value of the total index. So if CBA is worth 10% of the index, then 10% of our money goes into CBA. And the challenge, though, with market cap weighted indexes is that it can create concentration risk. And we've seen greater concentration risk. It's always been present to some extent in the Australian market, but we've certainly seen the greatest amount of concentration in the US market ever, in terms of the top 10 companies making up almost about 40% of the index. And you've got NVIDIA, which is about 8 or 9% of the index, depending on what day you measure it. So we never had so much concentration, and that creates some problems. Now, Vanguard will tell you there's nothing to see here, it's fine, because traditional market cap indexing has gone through many, many market cycles and the market is efficient. So as soon as those companies aren't worth what they're worth, the market will reweight and, you'll end up with a different allocation. And that is true to some extent, but we believe that adopting a variety of rules-based, evidence-based indexing strategies to try and address some of these limitations of traditional market cap indexing just makes more sense. And particularly where there is strong evidence of outperformance in certain market cycles. So for example, when growth stocks are really dominating the market like they are now in the US, and they're expensive relative to, long-term indicators, and they are, then it makes sense to use indexing strategies that break the link with price. So let's use something else other than the share price as a way of working out, how much do I invest in CBA, how much do I invest in NVIDIA and those sorts of considerations. And these alternative strategies could be things like equal weight index, a value tilt, which means investing in companies that are attractively priced, quality factor, which looks at low debt, strong cash flows, strong earnings, strong dividends, so really the fundamentals of the company. And so these strategies aren't picking stocks, they're still maintaining a rules-based discipline, but they're just allocating capital a little bit differently than other indexes like market cap indexing to kind of deal with that concentration risk and deal with the valuation risk in certain markets. Now, these different strategies aren't required all the time. When growth is eventually cheap again, a traditional market cap indexing will be perfect. But I think adding these additional strategies makes sense today. But they're not a shortcut to higher short-term returns. It's really the goal of them is to really reduce risk in a portfolio so that there's volatility. At least you're not putting all your eggs in the basket that's overcooked in terms of valuation. So it reduces risk and also exposes the portfolio to higher than average returns over the sort of medium term. So medium term's really 5 to 10 years. Okay, before I share a bit of a practical blueprint with you in terms of starting to invest in the share market, I just want to talk about, the domestic bias that we have in Australia. And you can see it when you look at industry super funds as well. If you look at a balanced growth or high growth portfolio, they're going to have somewhere between 20 and 50% allocated into the Australian share market. Now, the Australian share market is worth about 1.7% of the value of total global developed markets. So it's only a tiny fraction of all the companies out there in developed markets that you can invest in. So when I talk about developed markets, I'm really talking about, in the main, I'm talking about US, Canada, UK, Europe and Japan. That would be the vast majority of sort of developed markets. And really, if you add Australia into that mix, Australia's only kind of 1.7% of the total value of those companies. So therefore, by being focused on the Australian market, you're really arguably ignoring 98% of the investment opportunities that are outside of that market. And it doesn't always make sense, right? And particularly if you have a look at the last sort of 10 years and so, the local market has certainly underperformed relative to global markets. Now, there's times where that changes. And of course, when we look at global markets and we look at the US and Canada and UK, Europe and Japan, they all offer different risks and opportunities. So I don't think I would look at it as just a sort of homogenous sort of investment universe. It's really just about saying, well, here's Australia, it's very small, and then understand where global markets are at. And there's some sectors or geographical markets within that sort of global market definition that potentially offer far more attractive investment options and far more diverse investment options than what Australia does. And remember, in Australia, if you're just buying the index, you're buying really a lot of financials, the top 4 banks plus Macquarie, and then you're buying, the miners, Rio and BHP, of course. And that's a lot of concentration in just a few sectors. And Australia doesn't really have a huge technology exposure, for instance. So we think that investors should start thinking a little bit broader than that and maybe bucking conventional wisdom. We're going to share a episode. In fact, Campbell Wallace is working on some research at the moment. In February, he's going to publish an episode about, whether you should be or to what extent should you be investing in the Australian market. So that'll be an interesting one that's kind of one to listen to in addition to today's episode. Okay, so now I wanted to share kind of a bit of a blueprint to how you invest in shares. So what is sort of the process? Well, firstly, you need to start with sort of long-term goals and time horizon. If you've got a very short time horizon, then like only a couple of years, then investing in the share market could be a risky prospect because you really do need to have, different cycles. There's going to be different cycles. There's going to be a growth cycle. There's going to be a correction. There's going to be volatility, all those sorts of things. And to generate the average return, you really need a time horizon of 10 plus years. Now, you might be able to deal with a time horizon slightly shorter than that, but really that's the ultimate. If we can approach share investing with a 10 plus year time horizon, it allows us then to make good quality long-term decisions. The next thing then you need to think about your overall asset allocation. So how much you're going to put in shares relative to property, relative to cash. And of course, don't forget your super is typically genuinely invested in shares as well. So you can kind of consider that in your overall asset allocation. Then it's about choosing the right investment structure. So as I've spoken about here, it's really about low-cost index funds, diversified ETFs such as DHHF and VDAL, which are BetaShare and a Vanguard, all growth diversified products can be fantastic, or maybe some of the other alternative rules-based indexes that I spoke about in episode 380. You can go back and have a look at that. But it's about constructing a portfolio. Depending on the size of that portfolio would dictate, how complex you're going to be. So if it's relatively small, you're just starting out, I think a diversified ETF like DHHF or VDAL would be perfect. If you're building a more sizable portfolio where you might want to introduce some other alternative index strategies, factor investing, dimensional, fundamental indexing, equal weight, these sorts of things. And if you're investing substantial amounts of money each month or your portfolio is significant, well, then maybe you need to get some more specific advice in terms of portfolio construction. The next thing I'd think about then is really just making sure that you've got a well-diversified portfolio and then having some consideration to, whether you want how much you want to put into the Australian market, remembering that the global market really does or tends to deliver more growth and less income, which can be, a better characteristics for, building wealth, particularly if you're, more than 10 years away from retirement, because it's going to allow that compounding capital growth to occur. And then having the discipline of the regular cadence of regular investing. So, I think investing monies, every month into diversified ETFs is a really good kind of rules-based strategy that you can automate. There's plenty of tools out there that allow you to kind of automate that whole whole process, and then ensuring you've got discipline through times of volatility. So I'm going to talk about volatility in a second, but it's normal and you can use it to your advantage, and it shouldn't be something that, scares you away or concerns you. It's just part of the investing process. And I think this process then really allows people to kind of benefit from enjoying those market returns without the stress or guesswork that's often associated with share investing. That is, picking which funds to invest in or which stocks to buy, those sorts of situations. That creates that sort of friction and stress, I think, for investors, and ultimately causes them to perform poorly. Now let's talk about some common concerns around share investing. And I think it's natural to think about, is share investing too risky? Is it too volatile? Is it too complicated? Well, I think no is the answer to this, but not for everyone, I guess. Is it too complicated? Well, I think it's really just understanding how shares perform, how ETFs are constructed, and just at a broad level. You don't need to understand the nitty-gritty of it, but if you understand the basis for using those style of products and why they reduce risk and reduce the challenge of working out which stocks to buy and all those, or which fund managers to trust, then it starts to become more simplistic, I guess. In terms of volatility is just a natural part of the market. It's not a failure in terms of you've timed the investment wrong or you've got the wrong investments. It's really just inherent in the share market. It's going to have high volatility. Share markets are typically 15 to 20% volatility rate, and if the long-term return is say 10%, it means that 2/3 of the time your return is going to be between say negative 10% to a positive 40%. Now that's a really big range. So in any one year, 2/3 of the time it's going to be in that range. And that's the thing, right? Who really cares about what the return is this year? What you are most interested in is what is the return over the next 10 years. It's really that point-to-point return rather than, how it might change each year. So get used to the volatility, use it as an advantage in that, if there is significant volatility in one particular period, it's a great opportunity to buy more stocks at a cheaper price. And use that to your advantage, but just expect it, understand that it's a natural part of the market, and don't get spooked by it. The other concern is, well, if I'm investing in the index, what am I missing out on? For example, if you think about the thematic around artificial intelligence, well, then, it would make sense if I could find the technology or the business that is going to be well positioned to sort of harness that. So like the next NVIDIA, for example, then my portfolio is going to shoot the lights out. The reality is, though, that in any one particular period, whether it's a year or a couple of years, most of the index's return will be driven by only a handful of stocks. Like there's in the S&P 500, there's obviously 500 stocks. In the ASX 200, there's 200 stocks. But really, maybe the top 20 will drive most of the return. The issue is we just don't know which 20 it's going to be in any particular period. And so the answer is that index investors don't need to worry about it. They don't need to predict it because they're going to hold the broad market. And so they're going to capture those returns. So it might sound like an attractive proposition that, that you can achieve better returns if you pick those winners rather than just buying the whole market. The challenge, though, is the evidence tells us that it's near on impossible to predict those winners or pick those winners consistently year after year. So if there's a new technology or there's a new NVIDIA that comes out of nowhere, you don't need to worry about it. The market will then start pricing in that prospect or those growth prospects. The value of that company will rise. It'll then be included in the index. And there you go, we've got exposure to that company. So if there's going to be a successful technology or a successful company or a successful sector or new product or whatever it might be, index investors will participate in that uplift. Maybe not in the very early years, but certainly, when the substantial amount or most amount of, dollar value growth occurs. And finally, investing abroad, so investing in global indexes, sometimes is perceived as riskier. Sometimes share investors will prefer to invest in the ASX because they they know the companies, there's CBA and Telstra and Woolworths and, all these brand names that we're kind of familiar with, and we understand the business, and, we use those businesses ourselves. So it gives us a sense of sort of comfort around it. And so therefore investing overseas, I don't really know the market. So there's not as much sort of knowledge there. We've got currency fluctuations that could create greater volatility. But in reality, once you understand that Australia is such a small part of the investable universe, that you then realize that actually by focusing too much on Australia, you're really cutting out more than 98% of other investment opportunities. And that to me just sounds risky. So really, sum it all up, share market investing rewards discipline. Investors who stay invested through cycles, avoid unnecessary trading, and adhere to a clear strategy will generally outperform those who try to outsmart the market. Long-term wealth accumulation requires on capturing returns consistently, not occasionally. The share market is a powerful wealth building tool when approached correctly. And sometimes people say, I tried investing in shares, I didn't make much money. I feel really, I'm not very comfortable with it. Unfortunately, that's probably the result of, a past mistake. Whereas if you have a disciplined approach, it will complement other investments such as property. It provides that diversification, it provides greater liquidity, and enhances overall portfolio resilience. There's going to be times when the property market does really well and the share market doesn't, and vice versa. So by diversifying, you're going to sort of balance out the pros and cons of those two different asset classes. And by focusing on evidence-based strategies, maintaining discipline, that's key, and consistency, and allowing time to do the heavy lifting, investors can build a substantial amount of wealth by investing in share markets. So there you go. Just to summarize what I was spoken about today, it's really about employing a simple evidence-based strategy that works consistently. It's about understanding what drives returns in the share market, because that helps you then, adopt the right approach in terms of products and indexes that you use. Avoid those pitfalls, which, if you stick to the rules-based approach, you'll avoid those pitfalls, and think broader than just general traditional market cap indexing. Don't be too centric in Australian investments, and stick to it with long-term discipline. Okay, next week is the final in the 4-part series where I'm going to talk about cash flow and debt management. And of the people that I have read these blogs that ultimately become cast episodes, they think it's the best one in the 4-part series. So I look forward to sharing with that next week. Until then, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.